When you suddenly find that your wealth has become half, stock level, the correction was much higher, how would you look at it?
I think, it's all about managing emotion.
So should investors looking at, can they still look at a 14-15% type of a return for the next 5-10 years?
Typically, it's seen that the large cap companies' earnings grow a bit higher than that.
What does it take to manage, 46,000 crore of AUM and sleep peacefully at night?
I don't think in terms of absolute numbers. I keep thinking in percentages.
Hello and welcome to Ventura Spotlight. In this episode, it is a pleasure to have with us Mr. Rahul Baijal, Senior Fund Manager at HDFC Mutual Fund. Rahul has over 20 years of experience in fund management and equity research. He is an alumni of IIM Calcutta. Rahul manages assets worth nearly 46,000 crores with the flagship fund, HDFC Large Cap Fund, which was previously HDFC Top 100, HDFC MNC Fund, HDFC Business Cycle Fund, and HDFC Defense Fund. So let's get started. Hello, Rahul.
Hello.
So as we start off, how would you, explain to someone, as a novice investor, and many people would not know what you actually exactly do. So if you have to explain to somebody that what do you actually do, how would you do that?
So fund management, I think now is fairly popular thanks to social media and the business channels. But typically, the job of a fund manager involves you have various schemes with the different mandates in which you are managing money on behalf of retail investors, and you work along as a team. So there's a team of fund managers. There's a team of analysts supporting you, and together as a team, you basically are managing money on behalf of retail investors. So that essentially is the job of a fund manager.
So, everyone has one experience, that changes their path, right? So, did you always want to be a fund manager or you wanted to do something else?
Actually, that takes me back a long way. I grew up in Delhi and Calcutta, so I didn't have exposure to Bombay stock markets for the first 25 years of my life. And when I came to Bombay in 99, that's when my first exposure to the stock markets happened. So in 2000, I transitioned to the field of equity research, and that's when the journey began. So yeah, it's actually first half of my life was hardly any exposure to the stock markets.
So I think when you started, you witnessed the 2000 IT boom and the bust.
Oh yes, yeah, that's when I entered. In fact, exactly 25 years back. So yeah, I saw the build up of the IT boom and the dot-com crash as well. Yeah.
So how do you describe your crore, process of investing? How would you go about your entire approach of investing? So if you could help us understand that.
So yeah, so I've worked across different mandates across different firms over the course of last 25 years, and on the fund management side of the last 20 years. So essentially, it involves, if I were to put it in a short manner and in a simple manner, essentially, the core investing style is about investing in quality companies which are run by good managements, which have businesses which provide a sustainable growth with strong competitive advantages, and investing at reasonable valuations. So it's as simple as that. Now, this approach needs to be customized based on the mandate which you get. And like I said, and like you said, I'm managing different mandates, 4 different mandates over here. Each comes with its own particular characteristics. So this style is basically customized for these 4 mandates, and some risk management frameworks vary from mandate to mandate. So that's how it's done.
But how are you able to do that? Because in fact, when I looked at it, that you are managing, I think 2 thematic funds, right? I mean, I think the MNC fund is a thematic fund, and your business cycle is also more of a theme, one sectoral and one large cap. So how do you juggle your thought processes in terms of which stock should go into which basket?
So like I said, the investing style is like the backbone which I mentioned, and then each of these mandates are a bit different. in the sense the benchmark is different. So the large cap benchmark is the NSE 100. Then the thematic like MNC fund and the business cycle funds are different benchmarks. So essentially, you basically focus on stock picking based on the investing style I talked about, and then on a top-down blending basis, you basically customize how the portfolio construction needs to be done, keeping the risk management framework in perspective. So yeah, a bit of variation here and there, but essentially the core investing style remains the same.
Yeah, since you're mentioning about risk, I think that's one of the major factor, specifically in the fund management business when you're managing someone else's money. So how do you manage risk in your portfolio? Especially specifically when we have witnessed the volatility which we have witnessed just now. So how do you manage the risk part of the portfolio?
Sure. So if I were to give an example, like in the large cap fund, if I look at the risk management framework, essentially it's around a few areas. So firstly, in terms of diversification, there is optimal level of diversification. The number of stocks are around 40, 45 at any point in time. So it's not over diversified with 60, 70 stocks. At the same time, it's not too focused, with like 25, 30 stocks. So optimal diversification is one aspect of risk management. Secondly, in terms of sizing, how you size the portfolio in terms of individual stocks. So I have some sector deviation limits as far as sectors are concerned, and even some stock sizing limits. So that's how the sizing part is taken care of. And thirdly, in terms of style, I follow a blend style over here, a blend of GARP and value. So the style risk is also taken care of, because if you see the large cap space in the Indian mutual fund industry, there are funds which follow one particular style, and sometimes they do well when the market is supporting that style. But my view is that a blend style, if implemented well, has potential to create consistency in performance over a 3, 4, 5 year period. So that's the style I'm following, the large cap fund. So it's a blend of GARP and value, but with a bias towards GARP. So that's how risk management is done in the large cap product.
So just elaborating on that, a GARP basically, I mean, what you mean as growth at reasonable price, right? And
Yes.
so how do you determine the reasonable pricing of a stock?
So that varies from investor to investor. So if you look at India, I think essentially it's a growth market, and most investors are looking for growth ideas. If you look at the last 10, 15 years, and the same will be valid for the next 10 years as well. What one is willing to pay for, the price, I think is where the reasonable angle comes in. What is reasonable to one may not be reasonable for another investor. So I have my own definition of reasonable, and as far as that is concerned, I think I'm a bit tolerant when it comes to entry level multiples, P multiples for good quality businesses which have a long runway of growth, and I tend to hold them longer as well. Without bothering too much about stretched valuations, as long as I can see the compounding story to continue. So I guess that's how GARP is approached at my end.
Okay. So you mentioned about the PE valuation, and I think that is one number which is thrown around in the market across everywhere, and what sometimes it happens that a price which may be a PE multiple may be very high, but it is still cheaper than a low PE multiple. So can you actually throw some light in terms of because I think a lot of our viewers would actually want to understand that how to get the right PE, because sometimes we say that the markets are got a high PE and overvalued.
Sure.
So how do you determine that factor?
So I think when it comes to PE, one has to look at a few different aspects. Firstly, I think PE should be looked in conjunction with the EPS growth ahead. So looking at an absolute P makes less sense, but if you look at in conjunction with the EPS growth potential, it makes more sense, and that's how the PEG ratio, the PEG ratio, is looked at. Secondly, a PE should also be looked at for a company in conjunction with its own past. What happens is sometimes companies evolve, the business model evolves, the quality of return metrics evolve, and therefore at a stage of the business cycle when the return metrics are more attractive, when the growth outlook is better, companies tend to get slightly higher P versus their own history as well. And thirdly, Ps also need to be looked versus the peers in the particular sector or the industry. So I think P in isolation makes less sense, but if you look at P, keeping all these three variables in perspective, that's how I think the concept of P should be approached.
So, actually, even I agree with what you're saying, actually, that when we talk about the PEG ratio, right? And that is something which I think lot many people don't understand. What is the PEG ratio? So, if you could actually throw some light in terms of that, what should be a reasonably good PEG ratio as compared when you are looking at PE with PEG?
So, theoretically, you can find it in various investing books as well and on the net as well. But theoretically, a PEG less than 1 is considered to be attractive. So, basically, what it means is a 20p stock, which has an earnings growth profile of more than 20%, for example, will have a PEG of less than 1. But a 15p stock, which has a growth outlook which is less than 10% CAGR, will have a PEG of more than 1. So it's less attractive. So the P is 15, although it's less than 20, but the PEG is more than 1. So therefore it becomes less attractive. So that's how the concept of PEG works.
So basically the earnings are growing more than the price which you are paying for it.
Yes.
And that's the reason why the PE would actually also get re-rated in a way.
Yes.
Right?
So the concept of PEG basically implies that never look at absolute P in perspective, look at always in conjunction with the growth potential.
So one more thing, which most of us, talk about, is that sector rotation is a reality. I mean that, you keep on rotating, you have to rotate sectors. And so how do you identify those, when is the cycle going to turn? And, I think you are one of the best persons since you're also handling the business cycle fund. I'm sure you would be looking at it much more closely than many other fund managers.
So if I can plug in the business cycle fund, since you asked. So yes, I think timing sector cycles is not easy. And one of the drawbacks to the sector funds is that you can know when to enter, but it's always not easy to time the exit, right? So a business cycle fund tries to address this drawback in terms of investing for the retail investor. It leaves the timing part in terms of sector rotation to be done by the professional fund managers. So a business cycle fund typically will have a few sectors in which there will be disproportionate overweight and a few sectors which will be disproportionately underweight. And depending on the confidence and the visibility of the business cycle, these weightages would keep changing from time to time. And that those changes are done by the fund manager. So it takes away the timing part of entry and exit in sector funds from the retail investor to the fund manager and gives exposure to a few sectors at a particular time. So that's the beauty of business cycle funds.
But how do you identify that now this is a sector which is going to turn around, or what signals do you look at in terms of that this is now going to turn around and this is a sector to be looked at and this is a sector which is to be we need to ignore and get out?
So it's there's no right answer, but to because it varies from sector to sector. But I would say it's a combination of bottom up understanding and bottom up analysis, and you keep meeting companies, and you tend to get some flavor on how the various metrics at the company level and the industry level are changing. And then you form a top down view as well. And for example, for the IT services sector, you need to have some top-down view as to how the discretionary spending is going to happen in the Fortune 1000 companies in the US. And that has some correlation with how the economy is doing. And then that you combine with the bottom-up feedback from the various companies you meet. So I think a combination of this gives you some flavor as to how the business cycle is going to progress going forward. And you do this sector by sector and form views on the extent of the strength in the business upcycle left, and how much confidence you have in that visibility, and that's how you position yourself across in the business cycle fund.
So, they often it is said that investing is 1% intelligence and 99% temperament. So it I think more to do with maybe individual investors much more, because majority of them are driven more by the heart and less by the mind, right? So how much it is relevant even to the fund manager in terms of when you look at an idea, and according to you, what should investors actually do to get that temperament?
No, I think that's a very important question. I think managing emotions is a very important aspect of investing. I would not agree with the ratio 1% intelligence, 99% temperament. I think there's far more intelligence involved in the mix, but surely temperament and managing emotions plays a big role in investing. And I think as a professional, you work on that over course of your professional journey, and each market cycle, the up cycle and the down cycle, teaches you more and more of this aspect of growth. So it's been a journey. The from the dot-com crash 25 years back to the GFC in 2008 and to the 2018-19 correction, then COVID, and now the last 2 years. So, all these ups and downs have been learnings as far as managing emotions professionally is concerned. At the retail level, I think, like you said, there is a tendency to overreact more so because of lack of experience in terms of having seen cycles and done investing on their own. And there is a tendency to panic when sharp corrections happen and maybe sell out of funds or stocks, and at the same time get more greedy at the top, like last year. So I think SIP that way is a very well designed concept in the Indian mutual fund industry, and it's worked very well for most investors over the last 10-15 years. And so my advice to the retail investor is that the right approach to follow is you should have a base level SIP, which should continue over the years. And as your savings potential increases annually, you should keep topping it up. If you want to time the markets and maybe time it with a few lump sums when you think valuations are really stretched or the market is toppish, or you have a COVID kind of a correction, you should put a few lump sums. Sometimes you'll get it right, sometimes you'll get it wrong. But if you do have a good hit ratio, you can boost the SIP returns as well. But the underlying core SIP approach and the topping up should be a regular discipline.
Okay, so you basically advise that you do a sort of a monthly investment every month as a core basic, and as and when you get an opportunity in the market, you keep on adding more to it.
Yeah,
Okay.
monthly or quarterly, and once or twice a year you should reassess your your savings
But,
capacity, and accordingly keep fine tuning it, calibrating it as well.
But what happens, Rahul? What we have seen is that investors basically it looks very good when we are looking at a hindsight view, and the investing which we are doing is on the basis of forward looking, right? It's like if we see any time when the correction was there, so many investors who had a reasonable amount that invested in till 2007. I think that was one of the first crash which we had seen. Like we saw that in I think in less than a year or just about a year, whatever you had crashed 50%, even at the fund level or whether at the stock level. Stock level, the correction was much higher. We had seen Nifty, in fact, the Sensex crashing from 22,000 to nearly 6,000-7,000. Right, the recovery was also equally sharp. But when an investor sees that type of a fall, like if you have a wealth and you suddenly find that your wealth has become half, what sort of emotion the person should try to have at that point of time to hold that? What would how would you look at it?
Yeah, so the answer lies in the question you asked. I think, it's all about managing emotion.
Hmm.
And having seen so many market cycles now in India over the last 25 years, and after each market upcycle and a top, it's been followed by a newer high a few years later. So I think now we have a time-tested track record of SIP returns of mutual funds across various mandates as well over the last 10-15 years. So I think investors should take comfort from that. And as long as India's growth story outlook is structural and attractive, which I believe is the case for the next 5-7 years, at least, if not longer, I think there's no reason to believe why the future would be very different from the past. So I think investors should take comfort from that, and keep managing those emotions, keeping this framework in perspective.
Okay. Now, so we have had a very high inflation as a country. I mean, from the past, right? And because of a higher inflation, our return expectations were also higher, right? Now, as we grow as an economy, and now we have seen our inflation at sub 5 levels in terms of what it is there. So, should investors also moderate their expectations in terms of equity returns, or should they be still looking at can they still look at a 14-15% type of a return going forward for the next 5-10 years?
So I wouldn't hazard a guess, but what the framework I would leave you with is that I think too much inflation for too long is actually not healthy for the economy, and it does impact the macro stability framework and also the equity returns. Like we saw in FY10 to FY14, we had a period of very high inflation, and it led to issues on the macro stability framework in terms of currency as well as the fiscal deficit management, and eventually equity returns were also weak in that phase, and growth also suffered. So I think reasonable inflation is what is required, and right now the levels of inflation we are heading towards, and the macro stability which we have in terms of the currency outlook, the growth outlook, how CAD is looking given the level of Brent. I think we are in a very strong macro framework, macro environment for India. And given this macro stability and low levels of leverage at the government level, at the household level, at the corporate level, I see a long structural path of growth ahead. And as long as we can grow at 6-7% GDP growth with 4-5% inflation, and a nominal GDP growth being around 11% levels for the foreseeable future, typically it's seen that the large cap companies' earnings grow a bit higher than that. So, keeping this framework in perspective, I think equity returns should be fairly healthy going forward, keeping this framework in perspective.
Okay. So, what does it take to manage 46,000 crore of AUM and sleep peacefully at night?
So, I guess I do one thing which helps me. One, I don't think in terms of absolute numbers. I keep thinking in percentages and bips. So that's how I approach sizing and fund management. So the absolute number doesn't make a difference whether it's half of that or 1/4 of that, or even if it's double of that, hopefully someday. So thinking in percentages makes a big difference versus the absolute size. And secondly, like I said, each fund has a different mandate. You put in a process in place, you put in the hours and the discipline behind that process, and then you hope for good outcomes. So that's the best you can do, and that's what I keep doing. And yes, you sometimes do wake up early in the morning if there is a war going on the border, or if some announcements are coming from the White House. Yeah. So otherwise, I usually sleep peacefully.
So that's why now what we say is that markets are now 24/7 because something or the other is always happening in the world around us. So how do you carve out personal time for yourself to unwind?
So I guess so. I'm quite passionate about the work I do. I enjoy what I do. So that takes away a lot of the stress. Otherwise, whatever free time one has, the usual stuff. Spending time with family and friends, and a bit of sports and fitness focus over the weekend. Yeah, that's what I do.
Okay, so good. I think many investors can also have a fit portfolio if the fund manager is fit. So we just want to do a rapid fire with
Sure.
you. So one book every investor should read.
So I've liked The Most Important Thing by Howard Marks. That would be my recommendation. Yeah.
Okay. YouTube or LinkedIn?
YouTube.
Okay. Worst financial advice you have heard?
Buy every dip.
Okay. One business leader you follow closely?
I would say Bill Gates.
Okay. One food you cannot resist?
Samosas.
Okay. Thank you, Rahul. Thank you for being over here. Thank you.
Thank you.
Thanks for tuning in. If you enjoyed this video, hit the like button and subscribe for more content that makes your financial journey smarter with Ventura. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully before investing.